Silver, I'm calling for it to run to 75 from here. So it's at, 29 to 75, and then back to at least back to here and probably back towards, the low 20s, mid 20s to low 20s. So that one's much more volatile. And then post bust, post bust, I think the precious metals are going to lead the pack. I mean, you will see, I think, gold get to 20,000. So if it gets back to, say, 2,100 and then rallies to 20,000, almost tenfold move. And silver, I think, can get to 500. So, if it moves back to the low 20s and moves to 500, you're talking about, a 25-fold move. So there's, I think, a huge future ahead in the precious metals.
Gold concluded 2024 with remarkable performance, achieving its best annual return since 2010, with gains exceeding 27%. Many factors, including heightened geopolitical tensions in the Middle East, the ongoing Russia-Ukraine conflict, and unprecedented central bank purchasing activity, have sustained the precious metal rally. As Friday's European trading session progresses, gold shows strength ahead of the U.S. ISM Manufacturing PMI data release. Market analyst DavidHunter offers a notably dynamic forecast for precious metals. He suggests gold could reach $3,400 before experiencing a significant correction to the $2,100 to $2,500 range, representing a potential 25 to 30% decline. His longer-term outlook is considerably bullish, projecting an eventual rise to $20,000 from post-correction levels. This dramatic price trajectory reflects growing concerns about global financial stability and potential market disruptions. Silver markets have demonstrated particular strength, with prices trading around $29.60 per troy ounce and marking 3 consecutive days of gains. The metal's industrial demand created a record physical deficit for the 4th straight year in 2024, helping drive prices toward $35, levels not seen since 2012. This deficit underscores silver's unique position as both a precious metal and an industrial commodity, with demand pressures coming from multiple sectors. Hunter's projections for silver are ambitious. They predict a rise to $75, a correction to the low to mid-20s, and then a dramatic jump to $500. These forecasts consider both silver's monetary attributes and its increasing industrial uses, particularly in renewable energy and electronics, which could drive unprecedented price dynamics in the market. The precious metals market enters 2025 with strong fundamentals due to ongoing geopolitical tensions boosting safe haven demand and record central bank purchases absorbing supply. Silver sees pressure from robust industrial demand, and increased institutional interest strengthens market support. However, analysts warn to prepare for potential volatility and price corrections as historic levels are tested. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I don't think so. I mean, anything is possible, I guess. But if you look, even in 2008-9, it came back quickly, faster than the markets, but it did get hit initially, and I think that's what you can expect here. As I've said it, gold won't fall anywhere near as much as the equity market, in my opinion. Silver could. Silver's got more volatility to it, but gold, yeah, you probably see it down less and recover much sooner because the response to the bust will be massive money as well as massive fiscal response, government response. But that massive money response means people will probably take that as a signal that we got to get into gold again. So I'm kind of using it. I still think there's a big run in gold and silver here in the next 6 months. But I'm saying gold can get to 3,400 here before the bust, pre-bust, and then could fall back anywhere from its breakout point at 2,100 to mid 2,500. So if you do a calculus on that, it's basically saying it can fall by somewhere probably between 25 and 30%, something like that, which would be half or less, half or a third of what the equity market does. Silver, I'm calling for it to run to 75 from here. So it's at, 29 to at least back to here and probably back towards, the low 20s, mid 20s to low 20s. So, and then post bust, I think the precious metals are going to lead the pack. I mean, you will see, I think, gold get to, so if it gets back to, say, 2,100 and then rallies to 20,000, almost tenfold move. And silver, I think, can get to 500. So, if it moves back to the low 20s and moves to 500, you're talking about, a 25-fold move. So there's, I think, a huge future ahead in the precious metals. They're, unlike the stock market, where I think the peak this next year, meaning that 7,500, if that's what it turns out to be on the S&P, the peak we see in this cycle is likely to stand for decades in terms of the indexes. There'll be opportunities within the indexes, lots of groups that will do well, commodity producers, et cetera. But the indexes, I think, because of much higher interest rates next cycle, you'll squeeze PE multiples, et cetera. So I don't think you'll revisit the highs of this next, probably see the highs in the first half of 2025, maybe even first quarter. Those highs probably won't be seen again this decade and maybe not next decade. Whereas with gold and silver, obviously, I'm talking about 20 plus fold increases in the metals, and obviously the miners will benefit greatly if that happens.
The Federal Reserve continues its dual-track monetary policy approach, maintaining quantitative tightening while adjusting interest rates. Since 2022, the Fed has steadily reduced its balance sheet from its peak of nearly $9 trillion, with Treasury bond holdings now at approximately $6.9 trillion. While a return to 2015 and 2016 levels of $4 trillion appears unlikely, the current economic environment may justify a larger permanent balance sheet than historical norms. December's Federal Open Market Committee meeting revealed a more cautious approach to monetary policy adjustments for 2025. The committee has notably scaled back its rate cut projections from 4 to just 2 cuts for the year, reflecting the complex balancing act required by current economic conditions. Market analyst DavidHunter provides a contrasting perspective, suggesting that economic conditions could force a dramatic policy reversal despite the Federal Reserve's current stance. Hunter argues that a potential financial system crisis would compel the Fed and other central banks globally to implement aggressive quantitative easing measures, regardless of their current policy preferences. This scenario, if realized, could have significant implications for precious metals markets, which historically benefit from periods of monetary expansion. Let's get back to the interview.
I'm quite optimistic about what Trump is doing. He's coming in with a whole different understanding of Washington than he did, back in 2016. He's hitting the ground running, assuming most or all of his nominees get confirmed, and I think his cabinet posts get the people he wants. I am optimistic that Doge will make some significant cuts in government, and that we'll see a much more efficient government, 2 and 3 years from now. The problem is the macro trumps that. I mean, I'm talking about something we haven't seen in 90 years. You can call the Great Depression part of it was a bust. We did see massive bank failures around the world, and we did see, an economy that was far below any recessionary norm. So you could call that what I'm calling here. This one isn't going to be a Great Depression. It's not stretched out over a decade because they will print that money pretty quickly. But the damage that's done in that 12 to 18 month time horizon that we're in a bust is massive. And it not only is bigger than anything Trump can offset with, it also really short circuits some of what he, if he were coming in a normal time, if this were even 4 years ago or 8 years ago, and he were doing this, I'd be super optimistic because it's a very pro-capitalist agenda with pretty big deregulation, drill baby drill. So taking advantage of the resources we have in this great land, and cutting government, trying to reduce government's influence on the economy, which is usually a drag. Doing all of that, I think 8 years ago would have led to basically what people call the Roaring '20s. I think he would have seen that. The problem is he's coming in at this time when we're approaching that bust, and he doesn't want to just print money like crazy, but that's what's going to happen. It's not because of Trump. It's not because of Powell. Every central bank is going to have no choice if they want to save the system. You can sit back and say, well, we're not blowing up, we're not going to pump the system up again like we did, and the mistakes we made last cycle. And that's what Powell's telling you, right? He's pretty adamant he's not going back to that QE solution again. That's easy to say until you're staring it in the face and the system is basically melting down. You're having a free fall in the financial system. They don't have a choice. It's the only tool they have where they can move quickly and stabilize the system. So whether it's 20 trillion or something less than that or more than that, that's my best guess of kind of four times what we saw in the pandemic, and every central bank around the world doing the same thing. That's way past anything Trump can do at the margin, right? I mean, that blows you out of the water. We were a central bank balance sheet of 875 billion back in 2008 before the response to the financial crisis. 875 billion was the largest balance sheet we'd had going back to, was as big as we had gotten going back to 1913 when the Fed was put in place. And now we're talking, we got to 9 trillion during the pandemic, and we're talking maybe 30 trillion by the time we get through the bust.
Gold and silver continue to attract attention as both safe haven assets and essential commodities, reflecting the intricate balance of geopolitical tensions, industrial demand, and monetary policies. While the potential for substantial gains is evident, so is the likelihood of significant volatility, underscoring the need for strategic planning and careful timing in this dynamic market environment. What strategies are best for navigating the potential opportunities and risks in the precious metals market this year? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.